Let's welcome in now Nancy Curtin, AlTi Tiedemann, Global Chief Investment Officer. It is good to see you, Nancy, on set.
Good to be here.
So we were just talking about this market. I want to get your take on this because it has been, Nancy, a wild ride.
Boomerang.
We had the Liberation Day and headlines and reports and drama and blood on the streets. And then remarkable rebound. And as we were talking, Nancy, at the top of the show, now the S&P 500 goes positive on the year. What do you make of it? How do you explain that to your clients?
Well, first of all, we're long-term investors, and so we have stayed put throughout this entire thing and told our clients not to panic. Don't try to sell on the low and get back in again, and thank goodness, because you can never predict when markets turn around, and they turn around on a dime. Now, I didn't see this weekend, quite amazing what Besant managed to accomplish in China. And now, obviously, we have this 90-day pause. We're a little cautious near term. Again, we're not doing anything. We're long-term investors. We think we're well-suited. We're incredibly well-diversified. So our clients really navigated through the turbulence pretty fine. But I think, we are cautious. Markets have moved a lot here. And trade deals, let's just think about this. Trade deals versus LOIs, because what he got with the UK was a 5-page agreement, letter of intent. Yes. What happened with the UK was a 5-page little written agreement, more questions than answers. But I do think it sort of sets some of the framework. And what I mean by that is don't expect tariffs to go away. The 10% baseline tariffs we think is going to remain in force. China's going to be higher. We'll have the negotiations with other countries, but don't expect tariffs to go away. So, tariffs do have a negative economic impact. So we do see a slowdown in the U.S. economy as a result.
And do you think there's also, especially as an international investor, do you think that there is also a more permanent hit to foreign investors' interest in the United States, even if there are these deals that are forged?
So Walter Wriston once said, capital flows to where it is welcome and stays where it is well treated. So I just put that out there as a little snippet. But look, foreigners for the last 2 decades have been allocating huge amounts to the States. Why? It was rational. The U.S. across pretty much every asset class outperformed, and the dollar outperformed on top of that. So today they have very, very large allocations. About $30 trillion foreigners have allocated to the United States, and a lot of that's unhedged. So we believe at the margin, foreigners will allocate less. They're not going to sell all their securities. We're still the most liquid market in the world. We still have great companies and all the rest of it. But at the margin, if they allocate slightly less and or hedge their exposure, our belief is we could see a lower dollar than we've seen and or a higher cost of capital. We have to finance a $2 trillion deficit. We have $8 trillion of rollover risk. And now we may have some foreigners less showing up at the auctions. So this is something, it's one of the reasons we're underweight duration, underweight government bonds as a result.
Let me ask you this. You mentioned U.S. economic slowdown. That means what for corporate profit growth this year?
Do you know, I actually think that corporate profit growth will prove more resilient than people think.
Why do you say that?
Well, look, it started the year at 12, okay? We're probably going to end up 6 or 7, something like that. So it will slow down. But take a look at the first quarter. We're 90% of the way through the first quarter. The profit growth is 13.4 versus expectations of 7. Pretty much, 10, 11 sectors in positive territory. Margins have hung in there. Now, you can say, okay, that's backward looking, which it is, because that all happened before, April 2nd. But broadly, we think there's a lot of shock absorbers in the United States. There's a very good wealth effect. Mid to upper end consumers account for 88% of consumption spending. The tariffs hit low-end consumers. They're a regressive tax. We've got that. We've got the tax bill winding its way through Congress. We think that's encouraging. There's a lot of goodies in there. We've had record buybacks, and a lower dollar, by the way, means better earnings. So let's just factor some of those things in. So our view is not that they won't slow versus early year expectations, but they might just be more resilient than people think.
You all manage about $76 billion of assets. Talk to me about who your clients are and what you've been hearing from them during this period of time. Because, you did point out these tariffs might have hit low-income consumers, but they've also hit small business owners, some of whom are not low income, certainly.
No, absolutely. Look, we think, getting back to the U.S. economy, there will be a slowdown. There is a supply-demand disruption. There is a tax on the consumer. And by the way, Chinese manufacturing costs per hour are like $12 versus $30 in the United States. So don't expect that we're just going to go out and substitute overnight to something cheaper. But getting back to your question about our clients, they're ultra high net worth, so we're well diversified across asset classes. So that means we have things like, well, we have international equities. By the way, they're up about 13%. They've done very well this year. Infrastructure, we think infrastructure is like a multi-decadal theme here. Not only do you have digital infrastructure, there's no Gen AI without power, so energy infrastructure, and now we have onshoring of production and lots of incentives for companies to invest in the United States. We like infrastructure, that's been positive. Private credit's been positive. International equities, bonds have been positive. So a diversified portfolio navigated pretty well through that. Yeah, look, our clients called a lot. They were nervous, of course, but we continued to say, don't panic. Remember, we're long-term investors, we're well diversified, and we're navigating through it. And of course, now markets have come back.
Final question is, we're going to talk to a guest later in the show about gold. I'm just interested in your thoughts on the metal, long term. Are you bullish? How do you feel?
Yeah, so for our more liquid clients, gold has been in portfolios, has been great, right? It's up 70%. The last 2 years, you normally don't get a move more than, $1,200 in the gold price per ounce in a couple of years. It normally happens over decades. It's 25% over its moving average. It's very extended. So we have said to our clients, take a bit of profits, rebalance back to targets, massively outperformed in a portfolio context, but we still think gold is really attractive longer term. Central banks are diversifying. I talked about foreigners, they own a lot. They're diversifying their exposure. Central banks are doing that as well. And there's about 23 trillion of gold above the ground. That sounds like a lot, right? It's only 5 trillion that you can buy. So the supply-demand features there, we think, will still support gold longer term. So we still have it in client portfolios, particularly as a very liquid ballast. Other clients have other things, as I said, like private credit and infrastructure.
Nancy, thanks for coming in.
Thank
really
you.
appreciate it.
Thank you.